ratio. Now, we'll first take profitability ratio. Now, why are we using the profitability ratio? Is to measure the effectiveness of the management. You know, on the side of management, the only yardsticks or the only thing that you can use to measure the effective and efficient of the management is a profit. When the management is not making profit, you could have known that the management is not well organized. So profitability ratio can give us, it will help us to know whether the management of the company is effective. And where we are going to look into is the net profit percentage. Net profit percentage, we are given the formula there to know the percentage of the net profit they have, comparing with the current year and the base year. We have the net profit after tax times 100 and divided by sales. So you represent your figure, you round it off in percentage. If it is 50%, you write 50%. So in doing that, you can be able to know whether the company is performing very well. Then we have a gross profit ratio, which is the gross profit times 100 divided by sales. You know, you can associate gross profit with sales, and that is why it is being divided by the sales. Then we also have return on capital. That means what we're talking about return is also the same thing as a profit. And what are the returns when you put capital into business? What the expected end is to have returns on that capital at the end of the day. So you can do some measure, you can do some calculations to know whether there is a return on capital that you are investing into the business, and that is being put as the profit divided by capital employed times 100. And the capital employed can also be classified as total expenses minus current liability. That is what we call capital employed. So you use this total as your percentage. Then the next one, you have the asset turnover rate, which can be used as a sales times capital employed times 100. This is very important, and most of the times, often it normally comes out in the exam. So then we also have a liquidity ratio. Liquidity ratio on the other side, it helps in measuring the ability of the company in meeting its obligation when they are due. What are the obligations that we are talking about? We are talking about to meet their current liability at the end of the day, and that's what we call obligation. You know, that is why it is essential for company to have to be liquidity. And what are the that mean to have cash in hand, to have so many things that they can easily turn to liquid in order to meet some obligations when the need arises. So under it, what we will look into under the liquidity ratio is the current or working capital ratio. So it's always thinking as the working capital, and that is the current asset divided by current liability, and you represent it with a ratio. That means that is the 1. So you find the division of current asset and liability, and you use a ratio of 1 to measure it. That means it's talking about the current asset, how you can use your current asset to meet your current liability. That is what working capital is trying to tell us, that how many times can you pay your current liability? How many times can your current liability cover your current asset cover your current liability? Let's say we have a current liability of 20,000 naira, and you have current asset of 20,000, and you have current liability of 5,000. That means your current asset can cover 4 times of your current liability. That is what the current capital ratio is talking about. Then we have the asset test or liquidation ratio, and that is the current asset minus stock divided by current liability. That means this asset test or liquid ratio is trying to tell us that aside from having stock which is under current liability, you take stock out of current liability, then you know the remaining current asset, how it can cover your current liability you have at the end of the day. Then you represent it with a ratio. If it is greater than 1, that means the company is a liquidity company. that means they have a liquid that they can meet operation. But if it is below 1, that means the company is having problem, liquidity problem at the end of the day. Then we also have average stock. What are the average stock? Average stock can also classify as you can put it as the opening stocks minus plus closing stock divided by 2. You have your average stock at the end of the day. Then we have the stocks to net current asset, which is stocks divided by current asset times 100. You can represent that with a percentage. While we have a debtors ratio, and debtor ratio is associated with sales. So you can put it as a debtors divided by sales times 365 days. That will make us to know the ratio at which the debtor can know. It will help you to know the ratio of the debtors at the end of the day. Now we have a creditors ratio, which is a creditor. Creditor is associated with purchases. When you purchase, that means you are having creditors, which are the people that you are owing at the end of the day. You times it by 100, then you represent your answer in percentage. Then we have the working capital, which I have explained earlier on, that the current asset minus current liability will give you your working capital at the end of the day. Then we'll be talking about the investment ratio. Investment ratio, that is talking about shares on the side of shares, dividend, and other things like that. Share is an investment, dividend is a return from the share you invest at the end of the day. So you can use this calculation to get whether your investment is moving on and or to know whether the company will declare dividend at the end of the day. So now we're talking about earning per share ratio, and you can get your earning per share ratio by using profit after tax minus preference dividend divided by number of equity share. That means number of share issued to the public. You can easily know your earnings per share, which is the EPS. Then we have the price earning ratio, which is talking about the market value of that share. You know, as company is moving on and on, then the market value of their share begin to aggravate. That means it's increasing every year. As they are transacting business, they are going on, then the market value of the share begins to increase. So then divided by earning per share at the end of the day will give you the price earning ratio. Then we have a dividend yield. I mean, how can you cover your dividend from the share? How can you cover dividend that the profit can cover at the end of the day? We have a dividend per share times 100 divided by share price. Then the next one is dividend cover. That means the profit that the company has at the end of the day. How many dividends can they cover? If the total profit is 50,000 and they declare 20,000 dividend in a year, that means that earning profit can cover 2.5 dividend in that year. So that makes you to analyze that the companies here have hope in the company that they have shared in, and is telling the investors that they can get their dividend, they are entitled to dividend every year. So you can do it as earnings per share divided by dividend per share to get the earnings, and you can represent it with times. How many times can they cover it? Like I've said the other time, you can cover it 2.5 times. So that is that on the investment ratio. Now we'll go to the question per se to know how we can analyze it, given when you are given the trading profit and loss account and balance sheet at the end of the day. So these are the questions, these are the trading profit and loss account, and these are the balance sheet. So we are now required to use the financial statement to calculate, to analyze this question that we are given. We have to calculate our working capital, gross profit margin, net profit margin, current ratio, asset test ratio, rate of stock turnover, returns on capital employed, and the owner's equity. So let's begin to analyze it while we take the work calculations one after the other. So let's begin the calculation. So dream, bed, Drink Board Limited. Now we start from A, which is a working capital. Don't forget the formula. The formula for working capital is the current asset minus current liability. Now look at your total current asset. The total current asset is a 1,147,500 minus what is your total current liability. We have just look at the balance sheet. So at the end of the day, your working capital, just find the difference. Then you have 688,500. So that is your working capital. So that's your working capital. So working capital is that. Then we have we are told to calculate gross profit margin. So gross profit margin is the formula for it is gross profit divided by sales times 100. And looking at the trading profit and loss account, we have 816 as our gross profit, then divided by total sales, which is 2,040,000 times 100. So we just add it, you have 0.4. So you have times 0.4 times 100, you have 40%. So that means you can represent gross profit as margin. Also seen it as margin. So that means if a company is having 40% margin in the transaction, that means it's telling you that that profit is encouraging. Yes, it's encouraging when you have 40% of the profit. So it's on average level is okay. Then C, you have a net profit.